C.
Say you are muted.
Oh, thank you. I didn't realize I was muted. Sorry, apology for that. So basically what I've said is that to calculate goodwill, we first do consideration plus NCI. Then we remove the net asset. The net asset in this case we have been given is 2350. We know the consideration is 2.2 million. The NCI, we are using the fair value method, which is 450. If we were using the proportionate net method, then we would have gotten the 20% of 2350. But for now, we have been told to apply. So if we had applied, let me put it again here. We say if we had applied the net method, then we are basically saying would have had consideration will not change, but we are saying this would have been 0.2, which is the 20% of the net asset. And therefore, the net asset wouldn't change. And therefore, we are saying the total of those two, that is what would have been 2650. And this would not have changed, and therefore goodwill would have been different. Interesting, because now we are saying goodwill would have been more. It means that there is a gain somewhere on the NCI, but doesn't really matter. But what basically said, we have applied fair value method, so it's 3. Then we have been told on 31st of December, the recoverable amount, the amount that will be on the statement of financial position is 200, and therefore there is an impairment of basically all that is what that first part was all about. So we know goodwill is 300 million, and then the recoverable amount or the amount to be shown on the statement of financial position on 31st of December is 200 million, and therefore there is an impairment of 100 million. That is the first part of this question. So it's saying the goodwill arising on the acquisition of beef, that is 300 million, and the goodwill amount that should appear in the consolidated S. So the journal entry to record, because we have been told here, goodwill on beef was reviewed for impairment and was found to have a recoverable amount of 200. There was no impairment in the investment in fillet. Fillet in this case is our associate. So we are basically saying then you are supposed to show show the journal entries. Always look at what you are supposed to show. Show the journal entries required to record the acquisition in the group statement. So at that point, you don't know which acquisition are you. They did not, basically, maybe they want us to record. Remember, when we talk about net asset of 2350, we believe that they took into consideration the 45 million, which was the carrying value, because they cannot say the net asset fair value was 2350 without looking at the fair value. So in this question is a little bit tricky, but maybe they want you to record. I think the only thing we marked there was a journal entry to record this impairment. So the idea was calculate the goodwill and then pass the journal for the impairment, which is 100 million. And that 100 million, you will see that is going to be shared between the group and NCI. Okay, now the second part is now to prepare the comprehensive statement of profit and loss. So from 1st of September to December, how long is it? What proportion of the year? This is the parent company, this is the subsidiary, and this is an associate. An associate, we say we do a one-line consolidation. We don't consolidate the associate. We consolidate the subsidiary only from the date of acquisition. So we have been told this is a transaction for the whole year. From the notes at the end say all calculation and all expenses and gains accrued evenly during the year. So we are saying each month is equal to each month. We are saying here 8 months belongs to post-acquisition and 4 months belong to the pre-acquisition. So the first step when we are doing the statement of profit and loss is to split the expenses and the revenue in the proposed and pre-acquisition. So this is our figures. So we know this is the one I've extracted. So I want to copy. I will copy this one. Let me copy first. I'll copy the parent because we'll need to add the parent. I'll paste the parent there. And then I will say for this one, for beef, I'll only do the post-acquisition. Okay. In terms of, don't worry, let me put the border, then we can see. So we are saying this is the whole year. This is 1 year, full year. I want us to know. And here we want 4 months. Why 4 months? Because the acquisition happened on 1st of September. So we are saying September, October, November, December is 4 months in the year. And therefore, we want to know what is the proportionate in terms of that. So we can say this is equal to that revenue times 4, you divide by 12. So ideally, that is, if we do, I don't know whether we look at where the additions and deal with them. So we are saying this is cost of sale, again is 4 months. This one should be gross profit, should be those two, should be 264. This one is 4 months. Financing cost is 4 months. That one, there is nothing there. Then tax, profit before tax. Again, we can check, should be 108, I guess. Then this is taxation is 18, that's 90. Again, I like using the addition that there are no other comprehensive income in the subsidiary. And then there is gain on devaluation is 12. And therefore there's nothing there, and therefore this is 102. So we have said the first thing is to do is to divide what we have. This is the transaction for the full year divided between 8 months and 4 months. So ideally, if there are no adjustment now, we would just add these two columns and we get our consolidated statement of profit and loss. That's what we would do. But now we know their adjustment. So let's go and pass our adjustment as we explain them. I want to use some columns here. Whatever I'll give them some color just for the purpose of understanding. So those three, I'll say those are for the parent, adjustment that relate to the parent. And then these other ones with a little light color, there are also 3 in case there are 3 transactions. I'll say those are the adjustment for them. And then I'll copy this and say this will be our group. So this one will be the group. Let's say this is the consolidated after we do the adjustment. So we want to go through the adjustments, which I will put here for you to understand the journals. And we can start with the first one, which is the first adjustment we have said, the one for goodwill, which is required in the first adjustment there. Where do you put goodwill? We put it, let's put it under operating expense, and is a debit, so is a minus 100, isn't it? Of course, the other journal would, of course, debit our and credit our goodwill. So the adjustment, the corresponding arm for this, put this as debit. You can see operating expenses are debit and they are shown as minus. That's why I put minus, and I put on this side to know that it is an adjustment to the assets, which is a goodwill in beef. On the acquisition of beef is on that side. So it's 100 million operating expenses. We credit our goodwill with 100 million. That's how the journal would have been for the first one. Let's go back to our stories here and now go step by step. The first one I think we did. The only thing that we remember is that we have used the fair value method, meaning that 100 million impairment will be shared proportionally in terms of the profit attributable to the group and NCI. And we shall demonstrate that once we put the extension, which I said is a prerequisite for a consolidated statement of profit or loss and other comprehensive income. Then we go to the second one there. We say Meat owned 40% of the equity shares in Fillet for several years. So for this case, our associate has been an associate for several years. So it is continuing, and we know we accounted for it as a one-line adjustment. So what do we normally do? We go, now we know we have an associate. According to IS 8, we must show income from an associate separately from other incomes. So I'll go to my Excel here. I'll say we have other income there. I will not use other income. I'll say income from associate, because it must be shown separately, and that's what we call a one-line consolidation. So we are saying that will happen, and we say it is 40%. So we go and determine how much income did we make. So this is the associate. Let me highlight the associate that way. That is the associate. So associate, we do one line consolidation. However, even if we are doing one line, we don't mix between operating and OCI. Other comprehensive income must still be shown separately. So ideally, in this case, since they have other comprehensive income, which is gain on evaluation of property, then we are going to show that separately. And we know they own 30, is it 40%? So let's do the one-line consolidation. How do we record an income using the equity method? We debit our investment in associate and credit our income from associate. Let's now look at how much did they make. So we come here. That is the profit, 109.8. This is the profit from the associate. And we own the interest is 40%. So we want to recognize an income. Here, income is positive numbers based on what I'm saying here. So I will put a positive number, which is 0.4 times the profit, that is 109. That is the income from the associate. The debit side, because this is credit side, income is credit, the debit side would have gone to increasing our investment in associate. That is how we deal with it. So we have dealt with a one line. So we have dealt with note 2. We have recognized the 40% of the equity share, but there is also other comprehensive income, which is coming from the associate. Again, this one we can add it directly as other comprehensive income here. Of course, we will increase our investment in, debit our investment in associate, and do our gain in OCI of 40%. Again, is 32.4. Those two are shown separately. We don't mix the two. If there was impairment of the investment in associate, we would have credited our investment and reduced our gain. So that when we show there, we'll show one line. That's why we say it's a one-line consolidation. If there was a loss on impairment on the investment, then we would have netted it off from the income from associate. Sorry, let's go to the. Are we together so far?
Yes, Doctor.
Okay, so now that we have known how to handle the first one, we have known how to handle the second note. Now we go to the third note. The third note, what is telling us, at the revaluation, that net asset of 2350 is not what is in the carrying amount. There was a 45 million difference between the carrying amount and the fair value. So that has to be adjusted. Of course, the pro forma would have debited our PPE or our machinery with 45 million and credited our revaluation reserve. But then this 45 million has to be depreciated over the remaining useful life of 6 years of this machine. This machine, normally, where do we put it? They haven't told us where we put the cost, but we are saying, of course, we would have recognized for 45 million to increase the machinery at the fair value at the date of acquisition and recognize our revenue reserve, a revaluation reserve. Then we have to depreciate. Let's depreciate 45 million for the 4 months that was there. So what do we do? I will, when we say make assumption, you can decide where we'll make. Normally, machinery we say is for production, and therefore we are saying we are going to depreciate 45 million. The depreciation to go to cost of sale because it's part of the manufacturing process. Ideally, anything to do with the factory and production is part of cost of sale. And again, it is the subsidiary. So I'll put it on this side under cost of sale. This is cost of sale is increasing the cost of sale. So is equal to minus, I'll put minus being a debit. And I say is 45 million. We are dividing 45. Let me put in brackets. Then for board mass to operate well. We are saying we are dividing that times, divide by 6 years. Because the depreciation now, that is for 1 year. I don't know whether it will work. Then we multiply by 4 months out of 12. Then it's only for 4 months divided by 12. I hope it will work. Is that correct? If we divide 45 million, you divide by, it's correct, eh?
Yes,
So
it's
this
correct.
is
It's 2.5.
depreciation. Yeah, 2.5 would have been the depreciation for the 4 months from 1st of September to December. Of course, we have said we would have debited our cost of sale or depreciation, which goes to cost of sale, and credited our machinery or our accumulated depreciation for machinery. So that's how we deal with that. So the other arm of 2.5 is in the statement of financial position under accumulated depreciation or the machinery directly. So again, now we have dealt with the depreciation. We have, if we are doing the financial position, it means the asset would have increased the asset by 45 million, but reduced by the depreciation or accumulated depreciation of 2.5 million. Then now we go to our step of eliminating intra-company transactions. Remember, if we are only doing the statement of financial position, a sale and a purchase you eliminate, they have no effect at the gross profit level. But in the statement of profit and loss, we don't want to exaggerate. So if you sell 50 and your cost of sale is 20, so your gross profit is 30. But you could exaggerate and say you are selling 100 and your cost of sale is 70, your gross profit is still 30. To avoid that misrepresentation and to show the substance of transaction in line with the conceptual framework for financial reporting, then we have to adjust so that we show the substance of the transaction, that a sale between a group, when you treat the group as one, is not a sale. So we have to adjust both the cost of sale because the purchase and the sale are within the group. So we have to eliminate that intra-company transaction. It has no effect but it has an effect of exaggerating the amount. At gross profit, it zeroes up, it balances up. So we go to This we say during the post-acquisition, and this word is important. It is after the date of acquisition. Sometimes you get a question telling you during the year they sold 25 million, which happened evenly during the year. Then you have to determine of that amount how much is for the post-acquisition period. But here now it is straightforward because we have been told it is after the date of acquisition. So it's all intra-group transaction. So meat sold. Meat is, which one is the parent? Let me check. Yeah, meat is the parent and beef is a subsidiary. So we have been told beef sold, the subsidiary sold 25 million to, so we need to eliminate that. So we are saying there is in the revenue of beef, where is the revenue of beef? We are going to remove 25 million minus 25, and in the cost of sale of the parent, we are going to remove, that is 25 positive there, because we will reduce the cost of sale. So one we eliminate, one we eliminate, we reduce the cost of sale and we reduce the revenue. So at profit level, there is no effect, but we have removed intra-company transaction in line. But the second part is even more important. We are saying these goods, if the goods have since left the company, meaning when you treat the companies as one, then we are saying there is no other adjustment. But in the problem now here is that the meat that bought the goods is having inventory, and that inventory is reflected at the price that they bought from beef, meaning that that is not the cost to the company when you treat the two companies as one. And therefore, we need to identify the unrealized profit on closing inventory. So we are told these goods were sold at a margin of 30%. Margin and markup are different. I noticed students got lost when we did our test too. They were mixing up between margin and markup. I think the major difference is when we talk about a margin, we are expressing the profit as a percentage of the sale. When we talk about a markup, we are expressing the profit as a percentage of the cost. So those is the major, and you should not ever get confused. So here we are expressing, we are saying 30% is expressed as a percentage of the sale. So here the selling price was 25 million. So if we want to see the markup is 30%, and 30% you calculate it directly from the 25 because that is the selling price. And then we are told an amount of 3 million remain outstanding in beef in respect of this. So we are saying there is inventory of 3 million, and that 3 million has 30% profit in it. So we need to adjust that inventory, which is recorded at 3 million, because it has some profit, which is unrealized profit of 30%. So 3 million times 0.3, you get 0.9. So that 0.9 is profit that is held by beef, who are the seller, and the inventory is held by meat. So we need to eliminate that profit. So what we do, we go to the cost of sale of the subsidiary, which is the one selling. So basically we are saying we are debiting the cost of sale, which is increasing, which is increased minus 0.9. And then of course the credit will go to reducing the inventory of meat, which are exaggerated by that profit margin. If it was on markup, then of course you would have said 3, you would have calculated what the cost is, divided the 3 million by 1.3, and then the difference would have been the profit, the unrealized profit on closing inventory. And I think we have done that in the previous questions. So we have now dealt with note 4. So we have dealt with during the post.
Sorry, doctor. Sorry, doctor. That 25, mustn't we change it to 7.5?
Which one?
The 25 million. We reduced it by 3/10 to make 7.5.
Why?
Or do we record the 25 million intergroup?
No, we are saying 25 million was the sales between
Okay.
one company to the other. So we have eliminated the entire, because one company sold, recorded it as a revenue. The other one company bought and recorded it as a purchase. Remember, when we do cost of sale, it is cost of sale is what? Opening inventory plus purchases minus closing inventory. So all that purchases is under cost of sale. That's where we close it as a nominal account. That's why we are saying the 25 is intra-company transaction. I eliminated in full. However, I said all the inventory that is remaining, if that inventory was sold to meet and meet has sold all of it, then we make no other adjustment, because there is no unrealized profit. All the goods are not in the group anymore. However, we are now told of the 3 million of that inventory that meat bought is showing they have inventory of 3 million. But that 3 million they had bought from beef, and beef sold it at a profit. That's why we are identifying what is the profit in the 3 million. That is what we call unrealized profit. Hope I've explained.
Yes, thank you, Doctor.
Okay, now we go to the note 5. Note 5 is saying, since acquisition of its investment in beef, which is only 4 months ago, Meat has managed the administration of the entire group, and Meat invoiced beef for 2 million of its share of this cost. Meat recorded this transaction within other income and beef within other operating expenses. Ideally, we are saying Meat is a parent company, and therefore they have invoiced, and that is also intra-group transaction. This is under other income. This is the column under other income. So we are saying Meat has invoiced 2 million. So I want to subtract 2 million. And then the other company under operating expenses has paid, and they shouldn't have paid. So I add it back, because this is minus is here debit, so I credit is a positive. So we are basically saying this amount we also reverse, because you shouldn't make money when you prepare see if they are one company. It shouldn't be in a way that we are combining. Shouldn't be a way that you are making money from yourself. You can charge yourself. And consolidated financial statement assume the two companies as if they are one, and therefore they shouldn't have made money from themselves. That's why we are eliminating this intra-group invoicing. So Meat made profit, so we remove that profit of 2 million, and this other one incurred an expense, but it's not really an expense because we are treating them as one. That's why we are reversing the operating expenses. Okay, and then now we go to the note 6. The beef was reviewed. I think we dealt with this when we are doing the first part, where we are saying the recoverable amount was 200, and therefore there was a goodwill impairment of 100 million. And I think we have already recorded that. And then there was no impairment in fillet. If there was an impairment in fillet, then of course we would have reduced our income from associate, and credited, reduced also our investment in associate. Fortunately, for this case, there is no adjustment to be made there. And then now let's talk about note 7. Note 7 is saying on 1st of December, that is towards the end of the reporting period is 31st December, Meat sold some land to Fillet. Fillet is the associate for 6 million, and they recorded a profit of 4 million. What does that tell you? That this parent company sold a property and recorded a gain of 4 million to the other company. And that company, they also now have made money. Basically, what in real sense mean that they are making money from themselves, because the other company is their company to the extent they have an influence of 40%. So we are saying if they made 4 million, then the only money they made, they shouldn't have recognized the 4 million. They should only have recognized the portion of the profit that was made from other parties, not from themselves. Because if they made 4 million, then they made part of that 4 million they made from themselves, because they have a 40% interest. So ideally, we are saying we are going to adjust the income we are recognizing from with this profit that we did recognize that we made from ourselves. So of the 4 million, we want to see how much of the 4 million is self-profit. They made 4 million and the interest is 40%. So it is 4 million times 0.4%, 0.4, which gives you 1.6. So we go and adjust. We say we are income from associate here. We did not make, we have to adjust that from by 1.6, which is minus 1.6. Of course, it will go, the corresponding entry will go to reducing our investment. So we debit our income from in associate and credit our investment in associate, because we can't be making money from ourselves. So the other 2.4, ideally that's now the money we made from the sale of property, because we sold, we made 4 million, but we are 40%. So that 40% we must adjust, because we can't be making money from ourselves. Are we clear there? And then I think having done that, the rest is we have finished the question, and you can see we started after 9 and we are discussing it. So within 30 minutes, we have basically finished the question. The rest is additions. But in addition, let me now go to the rest is simple, because we are basically saying we have the parent here, we have the subsidiary, we have the adjustments here, and then now we add them up. This is, we will add up. This become our consolidated. But I also said it is madness, and to show a person has never been to class if he cannot do what we call, let me insert first. I'll insert extension. What I said we call extension. So whenever you do, always make sure you do the distribution or the attribution. Okay, I just want to okay. So these are some of the things you do as a framework, even as a framework, and then you can, I think this one, I put it there. Don't worry, that one is not necessary. So basically, I've said we are now just doing the addition, but we'll talk about attributable to, or we have to distribute the profit attributable to, and we have to split between the group and NCI. And the same will happen here. At the total there, we'll say attributable, and then we have to split that between the group and NCI. So basically now, all we are saying now, we can do our consolidated financial statement. In terms of revenue, we are saying we are going to add the parent, then we'll add the 4 months of the subsidiary, and then of course we will do the adjustment, which is a subtraction of that. So we say that will be our consolidated revenue. The same, basically, if I did, because I can actually do summation. And that summation, I can start here. It should work. I hope it's correct. So basically, I'm saying 837 plus 144 plus 2.5 plus 0.9 minus 25 should be that amount. And this should be the addition, hopefully. And then here, Again, we can do, it is from here to there. Other income, net income. Let me see, what did we do with other income? I thought we removed other income. Yeah, we removed some money. 64 point was investment income. I thought this is, where did we put investment income was different from, yeah, other income. Yeah, it is different. And that is profit for the year. What is this? I need first to get there. Is it correct? I think you are correct. 721. That's what we have profit for the year.
I sorry, doctor. That cost of sales, is it correct, that one? Mustn't it be
Cost of
minus
sale.
25? Yeah, minus
We
25.
are saying it's 837 plus 144 plus 2.5 plus 0.9 minus 25.
Or the 2.5 and 0.9 is pluses and the 25
Yeah,
is
they are
minus.
prices. That's, I put the minus because cost of sale here is reflected as a minus.
Okay.
Of course, my minus and positive is based on the numbers. We are reflecting debits as minus in this adjustment. Otherwise, here, that's why here I said this is a debit. That's why it's a minus, is reducing this income from associate. Okay, so that is the profit we get. Okay, are we fine up to there? Any question before we go to attribution and share the 721 between the group and NCI? Okay, let me now go to, I will talk about how we do attribution. And I will do two ways. Ideally, when you don't have time in class, you do it one way and the rest is a balancing figure. So we are basically saying, in terms of the profit, here before any adjustment with the group, the parent had 675 and the subsidiary had 90. And when we are talking, the share of non-controlling interest is only 20% of the 90. That's basically what we are saying. That 90 is the only thing that we can share to NCI, 20%. So I come here and start with the 90. I'll do it here. Let me call it subsidiary or beef profit. And we are saying we are starting with 90. That is the unadjusted here before. Of course, we haven't added the other things. Okay, so from that 90, we now look at the adjustment we made. We said the 25 is of no consequence, so we are only concerned with these other adjustments. So we are saying we are going to adjust 100 million, 2 million, 0.9, and 2.5. Those are adjustments to the subsidiary. So if we adjust that, we say 100 million, we remember what 100 million is, which is goodwill. There is 0.9, I think is also a minus. This adjustment that we did here, 2.5 and 2. 2 is an addition here. 2 is positive. 2 is the reversal of the charges they were charged for administrative of the group. And therefore, we are saying this is the adjusted profit now. So the adjusted profit is a loss of 11.4. Now we can say of this, how much is for the group and how much is for NCI. And basically we are saying NCI will be 20% of that. So we are saying NCI should take a loss of 2 points and the group should take the 0.8 times that. That is the share from, and if you add these two, they should give you the 11, of course. Okay, that is how we deal with. So here, what I say, when we come to attribution attributed to NCI, now here we are going to say, here it is this amount. Let me copy it directly from there. Is a loss of 2 points. That is the loss. And therefore we are saying this is equal to, now the balancing figure, it means a group has more. So that is how we do the attribution, because there is a loss. And the main thing is because we have shared the impairment of the goodwill. We can, however, look at this 724 is a profit we have shown for the group. If we have time, we can also prove it. And how do we prove it? We go the same way here. We say the profit for the group here was before, at this point, that's where we are looking, 679. 679. This is the profit. I think this is the profit we had here. 675. And then we take the adjustments that we have put in there. The adjustment we have put in there are, this is, we are leaving this. This is separate. We only take 43.92. I'll put them there. We'll add the income from this one. Then we'll subtract the other things. We subtract the 1.6. We know that is the profit. And we subtract the 2 million that we billed. I think the 2 million are the ones we billed for administrative charges. So we can get what the profit for that group is. So gives you 715. What did we at that point? Is there an adjustment we have missed out here? Because it should add up to the same amount if we add this up. Because the two amounts we want to come to 724. And we know here we started with 90. We made adjustments of these amounts. Is this one correct? Yeah, looks fine. This one is fine. This one is 42 is fine. 14 is fine. 64 is fine. This one correct? Okay. So what we want to do, we have, of course, used 724 as a balancing figure, but that 724, is this a profit or a negative, this 9 million now? Because I'm saying like I need to put it as a, if I put 9, it will balance, but why should it be negative? I don't want the negative. This is negative because it's a loss. Was this units correct? Okay, please help me with the notes here. Let's see which one did we get? Because we are having like some 20% of NCI. Let's go through quickly what is the here it was 0.9, isn't it? That is correct. The unrealized profit is on 30% of the goods. Okay, there was an amount here, we are told an amount of 3 million remained outstanding as at this good. I think this is this correct? This is the amount of, an amount of 3 million outstanding. I think here we messed up. It wasn't, this is not the goods remaining. The goods remaining were 40% of the goods. During the post-acquisition sold good of these goods were sold at a profit and 40 of these goods remained. This was basically saying there is a debt. 3 million was not supposed to be the goods. The goods were 40% of the 25 million. So let's work out that one again. I notice this 3 million is outstanding, not the goods. The inventory are 40% of that amount. 40% of 25%, 25 million is 10 million, and therefore 30% is 3 million. This is 3 million. The outstanding goods here, the unrealized inventory is 3 million, not, this is not 0.9, so that is 3 million. I just want to see why it's not 3 million. It changes everything. The other one goes to inventory, of course. Anything, any change in our profit here? Profit before, there we put now is it -3? It's even worse now. Unrealized profit. Oh yeah, it's credit. What we are saying is that this unrealized profit is to be added, so it is -3 there, sorry, to increase the cost of sale. And once we put it here, yeah, the loss increases, and therefore that becomes 2.7. That's a balance 722. Let's look at the notes again. Then we are saying 1st of December, this one we adjusted with 1.6, and the figures are to be 1.9, and the prices of meat for the year. Yeah, I think now should be fine. So once we have this, now let's first finish, do the other one in terms of other evaluation reserve. Again, we are saying this is this one plus this doesn't look right. So we're saying it's a parent plus a subsidiary plus the adjustment, which are the gain from the associate. And therefore now total comprehensive income should be equal to what we had as profit, which was this, plus that. And of course, then we do also the parent. So what we are basically saying here, in terms of comparing, if you look at there, you add here where we had comprehensive income. For the beef, we had a profit of 13 minus 13 is the 0.5. Let me work it out, is equal to, we use this one as that, then we add the profit, this one, to see the comprehensive income. We want to see the total comprehensive income that we are adding there, which gives you the total now for the subsidiary. Now the subsidiary was making loss. Now here, then we get the NCI portion, the parent and NCI. And here we are saying is 0.2 times that. And there is 0.8 times, of course, plus the parent. And the parent there, what do? We pick up what we got in the parent, which is that, and we add, we'll need to add the parent one there. Yeah, we picked this and we needed to add The parent share. Where was the parent share? We are losing some $20, 20 or something like that. I just want to check how much we are losing. Then we'll pick it easily. So once we do there, again here we say we just do the balancing figure. We say attributable to the parent, to the subsidiary, to the parent is a difference. But we start with, I always say, let's start with the NCI, what it is, and the balance we say we always do the other one to be the balance. Okay, I think it's 724, 722, 704 plus what was remaining there. I think we should be correct. We'll look at the solution. Any question so far? Are we lost? Sarah. Sarah, any question? Emilia, are you still there?
Yes, doctor.
Did you follow what we did?
Yes, doctor.
Yeah, so the point is what we have basically done, and I want to summarize. We'll look at the solution. I think we lost some $20. I'm not sure where, but we'll pick it up when we look at the memo. But I think the steps are clear. So I think the most important thing that we have said is that we split the revenues and the expenses of the subsidiary pre and post acquisition. Then we make the adjustment that relate only to the pre-acquisition period, which are the ones I've shown in a very spread way. I do not want to mix them. And then in terms of the associate, it has to be a one line. Remember, in associate here, we have said income from associate. That's the one I'm highlighting now. There is 43.92, which was the 40% gain of the profit from the associate, which was based on the 109.8, the 40%. And then the 1.6 was the adjustment of the 40% of the profit that they made from themselves. Then we, in terms of the consolidated financial statement, we are only showing one line. That's why we call the associate a one-line consolidation. Of course, we have also split in terms of the share of the other comprehensive income, because per IS1, which next year is IFRS 18, we do not mix operational things or things that are controllable with non-controllable things. That's why we have OCI is different from the other part. So they end up being two lines. Otherwise, that is one line. Then we add now, we make adjustment in terms of sharing, in terms of attribution between the group and NCI. What we must know is that NCI is only entitled to the proportionate share of their income earned only from the subsidiary. They have nothing to get from the group, because NCI is an equity in the subsidiary, not in the parent. And therefore, we only calculate the proportionate share of income that is attributable to NCI at the subsidiary level. And that's why I was going to the length to show what the income was before. Of course, if there were no adjustment, we would just have done 90 times 20% to show how much is the attribution to NCI. But now there was a lot of other things. there was an adjustment. I think the 100 million was goodwill, and we put goodwill here because goodwill was calculated using fair value. If we had used the proportionate net asset method, then of course that would have, the whole amount would have been borne by the parent, not by NCI. The adjustment would not have been done in the attribution. And of course, what we are saying is that at the end, NCI will grow by the share of their income based on this. If there is a loss, it will reduce. The NCI at inception, the one we calculated at initial recognition, will reduce if there was a loss for the year. And of course,
Sorry, doctor.
yes, go ahead.
I wanted to ask in regard of the goodwill impairment in the two valuation methods of NCI.
Yeah.
Does it only affect when only the impairment part, or does it affect any other thing in terms of the two methods of NCI evaluation?
Okay. NCI, the only thing, of course, goodwill you calculate at the inception per IFRS 3. If you have used the net asset method, ideally, that means that the goodwill that you calculate relates only to the past parent share only. And that's why if it is impaired, nothing of that impairment should go to NCI. That is the reason. Because the other one is proportionate. Exactly. The net asset is equal to their proportionate share of their equity. So there is no goodwill there. We are saying if you shared the asset, they have nothing. There is the amount balances to zero. There is no goodwill. Remember, goodwill is the value above the identifiable net asset. That's the reason. Otherwise, if there is goodwill that is also inherent in NCI, then you share. The loss is shared to NCI. Other than that, but anyway, every impairment must be recorded. But whether it will be attributed to NCI depends on how it was initially calculated. Have I answered you?
Yes, doctor.
Okay, so that is how we do. I think this question, there could be, I do questions in class without even looking at them. I think there is some little differences. I will look at it. I will go and look at there could have been, because I'm trying to balance, I'm losing like 20, but I'm not sure where we went wrong. Maybe the 3
Is
million
the 20 maybe not? Is the 20 that we are talking about? I understood said that
which
if there is
20?
no you see where we were saying we are out with a 20 or something like that. My question was at the bottom at the attributable. How I understood, you said that if there are adjustments in terms of the subsidiary, we are taking the whole profit, which is a 90.
Yeah.
And if there is no adjustment, we only take the 20% of the of the profit which is now in this case our NCI being 20%.
You?
Does that not have let me ask again. So we said if there is no adjustments in terms of the subsidiary, right?
Yeah.
We said the 90 the 90, which is the profit of the subsidiary.
Yeah.
If there is no adjustment, we are only taking 20% of it.
Exactly, yes.
But if there are adjustments, we have to adjust the whole profit.
Yeah, you have to adjust the profit, but you are only adjusting only where the profit is held by the subsidiary. If you want to share for sharing between the group and NCI. If the adjustment, for example, we have made adjustment for the profit of sale of property to a subsidiary, to an associate, you see that doesn't affect NCI. The 1.6, for example, was the 4 million they made from the sale of property.
Yeah.
So we are saying that's an adjustment, but that adjustment does not affect the profit of the subsidiary and therefore does not affect the share of NCI. We have used goodwill. We have used unrealized profit. We have used the operating expenses. These were where they were charged administration cost. They shouldn't have paid. And we have used the 2.5 was the depreciation of the fair value of the machinery. That machinery is a subsidiary machinery. That's how I've done the adjustment. In the olden days, IFRS 10 has gone through a bit of review. There were times they would say, and companies do this, and I think that is where sometimes the confusion comes. When you make this adjustment sometimes, those who are auditors know about materiality and those things. Sometimes they say, don't bother yourself with things that are not material, things that would not influence. So I've seen even some books, they just go and use 90 and take 20% and say that is attributable to NCI on the basis, and their argument is that they are immaterial in the context of the things. But in class, we don't want to say anything is immaterial. We treat everything as material because we want to understand the concept and the principle. Okay, I think we've done enough. I think we could have, we just go through. I will also look at this solution and see whether I did not look at it. I haven't looked at these questions for a long time, probably. But I think we'll be 95% right. But I'm a little bit embarrassed. I couldn't balance it offline. I'm able to pick questions of ACC and balance them off without looking at the solution. So I'm a little bit embarrassed with this one, why I didn't, but probably there is somewhere because I'm using sheet here and here sometimes is an oversight. I'll pick it up as soon as I print it out, I'll pick it up. But anyway, I think we understand the principles very well. We should be able, if you go and do a number of questions from even test 2, test 3 of 2023, exams of last year, just do a few examples and just get comfortable with doing these questions. You don't have to do it this way. You can, I always prefer using journal entries and having a highlighter, different highlighter. So if it's something is an adjustment that relates to profit and loss, maybe I use red and green. Then I know green is for where it's affecting the subsidiary, the other one is affecting the parent. Then when it's a statement of profit and loss adjustment, I have another 2 colors, or I do the same color, but I circle with a pen. Something that will make you quickly see the journal. When you are making adjustment, you can do quickly and say this is a profit, and you list, you check through, you are working, and you move fast. You just need to learn how to pick up and how to structure and how to pick up. You are working very quickly in terms of which adjustment you need where. Okay, otherwise, if there is no any question, I think I will leave it at this point, at this here.